Welcome to our eSignal Weekly Forex and Futures Forecast. My name is Jay Norris. I teach trading at Trading University. As always, we need to remind you trading involves risk of loss and is not suitable for all investors. Before we get to the charts, a couple of people had sent me emails and said, hey, we haven't seen how your benchmark is performing. I just hadn't gotten around to putting it in the weekly report. There it is. That's our benchmark. That's the P&L for Trading University's 15-minute benchmark trading method year to date. And there it is. Yeah, pretty good numbers. It's based on a $50,000 account. So there you can see the profits, $21,000. So pretty darn good performance. And essentially two-way trade the last couple of months too. So we're pretty mindful when you can do that well in both up and down markets, essentially counter-trending markets. That's a pretty good deal. Hey, let's get to the charts. First market we'll cover will be the Australian dollar. Aus-US dollar running into some resistance. Here's what I want to show you. If you pop out to the weekly chart and you just take a look at your last impulse move down, essentially at the beginning at the new year, you look at your weekly chart and you eyeball your last impulse move down. You were not able to retrace more than 2/3 of that. You continue to hit resistance at that 2/3 level. So to us that says, hey, there's still more downside here. Kind of no surprise, last week the Australian Central Bank, they came out and they're actually forecasting slower than expected growth. That's never good for international currency. On the other hand, a lot of talk that all the rate cuts are priced in, and that's it. You won't see any more. Well, there's some argument you'll see one more. Either way, though, that dovetails with our own thesis overall that you are in the process of carving out an intermediate term bottom here. On the other hand, that doesn't mean you're not going to see lower prices still. There's plenty of room for this guy to back down here, and we think if you back down towards 77, you'll find a little bit more value down there. So, if we're liking this overall trot bottom here around the 76 level, then hey, eyeballing buying dips doesn't look like such a bad deal. You have a higher high here compared to that high, so you have a higher high in, so it's naturally we'd look for the next move, which would be a higher low. So we'll keep an eye on that. We're by no means bulled up here. We think there'll be some more downside too, but we think that's going to be somewhat limited going forward. Next market, dollar Swiss. Dollar Swiss, they beat up on it pretty good. You're seeing a pretty good turnaround late in the week. I'm not sure if that'll have legs or more of it's your typical counter trend move Thursday into Friday. You do see really good support down below here, though. 90 looks like you got pretty good support in dollar Swiss. We think long term that'd be an area where you'd want to add to your longer term longs here along the dollar versus the Swiss, short the Swiss. I'd say even right now, this is probably an area of the chart we could start to dollar cost average this guy, start to build a cash position here going long the dollar against the Swiss based on that support just below. And you dollar cost average slowly and you don't mind lower prices. They're there to help you out actually. Yeah, so we think you'll see some upside here. Maybe not, maybe haven't cleaned it out enough yet to turn it around in a hurry. Again, you may see slightly lower prices. That's why we like the dollar cost average strategy. But overall, we think there'll be plenty of upside here. And as a reminder, pop out to that monthly chart, and you can pretty much see you're more or less in a sideways market the last few years, but plenty of upside up above. Next market, the dollar index itself. Dollar index holding support, that level you're looking at, that it's finding support on. That's essentially a 2/3 retracement of the 2015 move. If you take this year's low over here and draw that up, and you'll see that you're finding support on the 2/3 level. I wouldn't want to fade that level, by the way. I think the short covering rally that we saw in the euro, the long liquidation, essentially a correction in the dollar. I think right now it's probably even money that thing's run its course. I'm more interested in just watching this thing and looking for some life on the upside. If you have a shift in momentum here back higher, I think you better take that seriously. So dollar index correction may have run its course. On the other hand, when we look at how we trade, here's our RTT ratio. You still have the majority short-term patterns down. That being said, not a lot we can do from a trading perspective. So shorter term, we're more or less on the sidelines. The longer term investor, however, this is probably an area on the chart where if you're trading a stock account, you can start to dollar cost average in and go long that dollar again. As far as using leverage, however, I think you got to be on the sidelines still. Here's the euro itself. You're starting to see better economic numbers in the euro, and I tell you, the funny thing is, if you've had terrible numbers for so long, any kind of a uptick is going to be exaggerated. It's going to look good, and I think that's the case in the euro right now. By no means are we bullish on this guy. We think you'll continue to see two-way trade in here. Probably a good way to go would be, if you see that market kiss 115 or so, or even what's our level there? It looks like, right around 115. You see a tag of that level, you could probably take that as a signal to start dollar cost averaging short the euro again. As far as smaller cash positions, as far as using leverage from a trading perspective, you probably need to wait for more of a shift of momentum lower here. When you look at again our RTT ratio, and this is what guides us as traders, you have the majority pattern still up, so you'd need a short-term shift in here. I think I have a line drawn there. Let me go down to a 4-hour chart. As from a trader's perspective, we need to see this line get penetrated, then we look to sell rallies. You get a couple closes below that level, 111.70 or so, then you get a hiccup, then you get a rally to sell. We'd go after that with leverage, but from a little bit longer term perspective, this guy may just have a little more life on the upside again, because you've had such terrible economic data that any kind of a little hiccup, any kind of a dead cat bounce is going to look good to them, and people are going to see that in the press, and that's going to continue to run shorts out of this market. We see this move overall as basically a dead cat bounce, short covering rally here, running shorts out of there. Next market, the gold market. They had gold on the ropes and they let them up this week. You got a little bit of a turnaround short term. Our 5-day pattern held there, so a little bit of a glimmer of hope for gold bulls. The 5-day pattern shifted higher. That 50-day held. Here's what happened. The 50-day pattern held, and that shifted to 5 up. And here's our ratio there. Gold starting to go counter trend on us. Overall, however, it's a bear market. Long-term patterns are down. Intermediate-term patterns are down. So we still favor selling rallies in the gold market. Last market we'll cover will be U.S. 10-year interest rates. 10-year rates still favor a stronger dollar. You can see an uptick in rates. You had in the beginning of this week, last week, typical financial markets. You had a counter trend move lower here Thursday into Friday. Probably some profit taken, etc. Market gets a little ahead of itself, but look, you took out a long-term trend line here, so we still like higher interest rates. When you look at that yield, it's above 2%. That's a whole lot more than you're going to see in most of your trading partners. The only yield out there slightly higher is still the Australian 10-year government bond. So Aussie still slightly higher rate than the U.S. last time I looked, but U.S. rate significantly higher than you're going to see in Europe. And we think that big interest rate differential between the United States and Europe is still going to favor a strong dollar long term, just as it will support the weaker euro. Thank you so much. We'll leave you with a picture of our track record on our short-term benchmark. We prefer that short-term benchmark because it's a 15-minute signal, so it gives us a lot of signals. So obviously, the more signals you have, the larger sample size you have. So we prefer that. The bigger the sample size, the better in this business. That's for sure when it comes to a benchmark, when it comes to trading performance. Thank you so much. My name is Jay Norris. I teach trading at Trading University, and we'll see you next time.